This simple strategy has outperformed the market for decades and very few people use it. What we see here in blue, that's the S&P 3. What we see in orange, that's the S&P 500. Now that's on a linear scale. Here's the same on a logarithmic scale. The outperformance is quite consistent. The common narrative is that it makes sense to buy the entire market, to buy the S&P 500, let's say to buy an ETF like VOO and simply just ride the economy, simply just be invested long term and not even try to time the market. When we look at the data though, we can see how a few outliers outperform massively, how they tend to accumulate our profit. If you buy the S&P 3, so the top 3 stocks, based on their market caps, so mainly NVIDIA, Apple, and then afterwards Google, we are doing much better than just holding the S&P 500. We are rebalancing here once a year, so we don't have any tax issues as well. And of course, 10 or 20 years ago, we had very different top 3 stocks. We had ExxonMobil, AT&T, Microsoft. We had General Electric and Pfizer. And all we do is just look at the top 3 stocks and then allocate towards those 3 stocks. Now have a look at this. This is the annual outperformance. So the S&P 500, that's here again in orange. The S&P 3 is in blue. And here is the delta. We tend to see quite consistent, quite high outperformance. How high? Have a look at this. The S&P 500 returned on average 10.5% over that time period. So since 1990, the S&P 3 returned 17.7%. What kind of a difference does that make over those 36 years, roughly? The difference is massive. The delta compounds. If you had invested $100 in the S&P 500 starting in 1990, you'd now have $4,000. But if you instead invested always in the top 3 stocks, according to market cap, you'd now be at $42,000. More than a 10x difference. Consistent outperformance compounds massively. Here's an overview, by the way, comparing the S&P 500 to the S&P 1, so only owning the larger stocks, the S&P 2, the S&P 3, etc. The S&P 2 or the S&P 3, I believe, are the best choices. Now, currently, the largest holding is NVIDIA. We started buying NVIDIA, according to that strategy, 2024, and it became the largest holding. Now, here is the NVIDIA price over time. That's again on a logarithmic scale. Here's the same on a linear scale. So obviously there's quite a bit of a difference. We do have our massive crashes in NVIDIA as well in the early days. But then crypto mining took off and afterwards the AI boom. And that pushed NVIDIA to a completely new level. Now have a look at this. This is NVIDIA relative to the NASDAQ 100. Or QQQ, a very popular NASDAQ 100 ETF. Again, we do see outperformance, but the outperformance isn't as consistent. Again, this chart versus this chart. The alpha or outperformance is a bit more erratic. And when we look at that outperformance in the last 2 years, there really wasn't that much alpha to be made, only 11.5%. It's still better than holding the S&P 500 or the NASDAQ 100. But really, the beauty of the strategy is in its long-term compounding effect, that the outperformance is so consistent that there are barely any phases where the S&P 500 did better than the S&P 3. Now, maybe we can time this a little bit. So that's another thing that's not a common narrative in the investment world. The common narrative is to only set and forget. We dollar cost average, say in the S&P 500. We don't try to time the tops and the bottoms. Nobody knows when something is cheap or expensive. That's usually the narrative. But maybe that's not 100% true. Let's try to time the market using momentum indicators. So let's look for golden crosses and death crosses. So when 2 moving averages cross, here is the back test that I've run. We've got a fast, simple moving average on the y-axis and a slow moving average on the x-axis. And the combination of the 2 best moving averages to generate those golden and death crosses. They are shown in those individual data points. When we are very green, it means we generate a lot of performance. When it's red, it's not so good. After I got that picture, I calculated every single data point. I increased the resolution. This, by the way, all comes from Bitcoin Strategy Analytics. So that's the backtesting platform for the premium members of this channel. Here is NVIDIA. We can also backtest all kinds of crypto assets, but this is the backtest for NVIDIA. We look for the best 2 moving average crosses, and we're looking at when do we buy the asset and when do we sell the asset? When are we potentially just in cash? And we can see there is an additional alpha to be made here by roughly 10 percentage points on top of just buying and holding. The main difference though is that our maximum drawdown is massively decreased. Again, NVIDIA had some rocky times. The maximum drawdown was roughly 90%. That's what we've shown over here already. But timing the market with those moving average golden and death crosses reduces that drawdown quite a bit. Here is how that looks like over time. So let's look again at the 6 versus 188 day simple moving average. That's the best combination. So let's again look at the 6 versus 188 day simple moving average. That's the best combination. And see how we exit the market when NVIDIA crashes. We are in the market when NVIDIA tends to perform. There is some alpha, but the main improvement is that there is less headaches during bear markets. Here, check this out. This is the year 2002 when NVIDIA went from top to bottom down by roughly 90%. With that moving average cross strategy, we are avoiding 74% of that crash. Currently, by the way, we are bullish. We got a golden cross. Now, I do think that investing is a game of opportunity cost. And so we have to ask ourselves, does it make sense to buy, say, NVIDIA over the NASDAQ 100? When do we actually get the outperformance? Maybe timing NVIDIA just based on the price isn't that smart. Maybe it's better to look at whether or not we should be in NVIDIA or in the entire NASDAQ 100 at a particular point in time. Again, this backtest here only looks at the top 3 stocks and it only rebalances once a year, and it is pretty much set and forget. And so if you're not a fan of timing the market, you can simply just follow that. It's definitely a viable approach. I think it's better than just going with the common narrative of getting into the entire S&P 500. I don't think that there's that much additional diversification benefit. Just have a look at how the volatilities change. On the x-axis, we've got the number of holdings. On the y-axis, we've got the annual volatility. Yes, the S&P 500 does have slightly less volatility, but the S&P 3 has that much more performance that I think it's worth that additional price risk. Again, when we look at this year over year, there's really not that many times where holding the entire index was that much better. That being said, let's do a back test. So this is the golden and death crosses for the NVIDIA price directly. Here is the same for NVIDIA relative to the NASDAQ 100. Now we are getting to an annualized alpha that's more than 10% versus buying and holding. So we timed the market slightly better. This is the outperformance using the relative valuation, and this is the outperformance using the price directly. What's the best moving average combination? In this case, for NVIDIA relative to the NASDAQ 100, it's the 14 versus 149 day simple moving average. So that's this over here. It also turned bullish just recently. But again, this is really just for squeezing out a little bit of extra return. It does require more active trading. It does require to compare NVIDIA relative to the NASDAQ 100. So to look at TradingView, enter that ticker, enter the indicators, and then check this out every single day, which is much more active compared to just rebalancing the portfolio once a year. It needs to be worth it to you, and you need to be properly aligned with taxes, that you don't get short-term capital gains tax, right? You want to be based in a country where this doesn't exist. The simple strategy is just to hold the top 3 S&P 500 stocks and rebalance that once a year. The more active strategy is to follow those 2 moving averages. Whenever the shorter term moving average is above the longer term, we are golden, we go up. Whenever we are below, we tend to rather go down. There's of course a way to get those signals without having to check the chart every single day, right? So this is actually also included in Bitcoin Strategy Analytics. You can just turn on email alerts or Telegram alerts, and then whenever something interesting happens, you will get the chart together with the call to action. And so I find this fascinating. Once we crunch the data, all of those common wisdoms get thrown out of the window. It does not make sense to own 500 stocks. It does not make sense to diversify blindly. It does not make sense to just buy, set, and forget. It does make sense to buy the top stocks. The top stocks tended to outperform. It also does make sense to time the market if you are tax efficient and if you want to get into timing the market, if you want to be involved in all of this. If you can't be bothered, then by all means just continue to buy the S&P 500 blindly. Of course, it does make money, but there is a big cost towards that. It doesn't seem like much, 17.7 versus 10.5% for the yearly rebalancing. But those 7 percentage points, they make more than a 10x difference over the course of an investing life of 36 years. And then, of course, we have similar deltas on top of that if we are okay to time the market and do more active trading. Hope you got some value out of this video. Feel free to give it a like. It helps the channel grow. Feel free to also subscribe. I publish here regularly. See you next time on YouTube or potentially see you in premium as well. Cheers.